My name is Dean Crocker and I'll be taking you through the latest EIA completed on Rio Tinto PLC. Rio Tinto released their full year 20 results, period ending 31 December 2020, in which they recorded a strong increase in revenue of 3% to $44.6 billion. Underlying EBITDA also increased 13% to $23.9 billion, resulting in underlying earnings increasing 20% to $12.4 billion. Looking at the normalized free cash flow, it essentially remained unchanged at $9.4 billion, benefiting from higher iron ore prices, whilst the net debt decreased significantly by 82%, from $3.7 billion to $0.7 billion. Effectively, the normalized free cash flow therefore outstrips net debt by a significant amount, resulting in quite a stabilized and strong balance sheet with excess capital allowing them to utilize for further capital expansion, or in the case of the recent results, distribution of dividends to shareholders. As we just recently discussed, total dividend per share was increased by 26% to 557 US cents, and a special dividend of 93 cents was declared as well. This is the second special dividend, as the first one was declared in last year's interim period. Thus, there is a decent track record of the company distributing excess earnings back to shareholders. In terms of the segments, iron ore segment really benefited from significantly higher iron ore prices. Currently at the price we did spot, they're about $160. They realized a price of only about $99 during those set of results. Thus, there is some upside that the segment should experience in the next set of results. Aluminium prices came under pressure, resulting in EBITDA declining 6%, whilst copper and diamonds also reported an increase of 5% in EBITDA, and the energy and minerals also fell, unfortunately, 7%. Based on the impact on the day of results release, the share price closed 0.4% lower, very marginally lower, to 62 pounds, whilst the Dow Jones closed 0.13%. Thus, it does seem like the investors took the news a bit badly, but really marginally in that sense. Since the start of 2021, Rio's share price has outperformed the Dow Jones by 5%, with a total year-to-date return of 6.9%. In terms of valuation, on an EV/EBITDA basis, it trades at a 26.5% discount to its 5-year average, 5.8 times, and a 12.4% discount to its FactSet peers. Given that, and looking at the various other relative value measures, the counter definitely seems to offer value, particularly given that the spot prices has far exceeded where they currently realize their prices. So there is some upside that will be built in quarter one and quarter two, most likely, of the 2021 full year results. We are, however, cognizant of recent ESG developments, particularly the destruction of the caves in Western Australia. This did occur in March 2020, so it was quite a period ago. However, the backlash has lasted quite a significant period of time, and most recently, senior management has seen some changes, with the chairman as well as the CEO both resigning from their positions as a result of the destruction of those caves. We are, however, aware that there's quite a bit of royalties attached to these agreements with the Indigenous people of Australia. Thus, it might be short headwinds faced by the ESG backlash, but no doubt that the management team is working quite extensively to try and rebuild those relationships and place the business in a good founding footsteps for going forward. In terms of the assessment, so given the free cash flow is so significant off the back of the high iron ore prices, the group has really managed to de-gear the entire balance sheet. They effectively sit on a great cash position with very little debt, allowing them to declare quite a nice amount of dividends as well as special dividends back to shareholders. They are also obviously benefiting from the higher iron ore prices and commodity prices in general. Copper has increased, aluminium is now increasing as well. So pretty much across the entire broad range of products that they offer and commodities in which they deal, they are seeing a lot of tailwinds coming through from the higher spot prices. We are, however, cognizant that valuation at a spot price can be quite volatile. And as such, when we did our analysis, we did see that consensus had only built in a spot price of about $125 per metric ton for iron ore, where the current spot price is currently about $168 per metric ton. Thus, there's quite a significant margin between the lowest kind of consensus value and the real spot valuation. Thus, based on a spot valuation, the counter definitely offers value. They're also in a great position given that the balance sheet is so strong, distributing a large amount of dividends and excess earnings straight back to shareholders. Thus, you're going to benefit from a higher dividend yield, whilst the commodity price cycle remains quite high. So there's definitely a lot of benefit to the counter right now and a lot of tailwinds. Thus, based on all of the above, our recommendation is an overweight. But we are really cognizant that spot prices do change and fluctuate quite quickly, and thus an investor should just be cognizant and mindful of significant movements in spot prices, just to be ensured that you are managing your own risk in that sense. If you'd like to place a trade, please speak to one of our dealers. Alternatively, you can speak to your financial advisor. And then just finally, please take note of the disclaimer. And thank you very much. Have a good day.